Good afternoon, Jaco. Nice to have you on this program. We're going to be covering Sylvania Platinum today with the Edison TV. There's some questions that we prepared that we would like to ask you, and I think without further ado, let's just go straight into it. First question: Sylvania FY24 production was under pressure due to the strike you had last year, but FY25 has started stronger, and you have just recently released your Q1 results. Can you please talk us through the main highlights for the past quarter?
Thank you, Renee, and thanks for the opportunity. And if we look at the past quarter, I'm very pleased with the progress we've made so far during this first quarter, which has yielded strong results in line with our expectations. I think firstly, from a production point of view, we achieved a 12% quarter-on-quarter improvement from the last quarter we had, producing about 19,160 ounces. And we also, what's important, managed to achieve it safely with no significant safety, health, or environmental impacts reported during the period. As a result, we maintain our production guidance at 73 to 76,000 ounces for the 25 financial year, and we're confident about production going forward. On the financial front, although the PGM basket price has seen about a 2% decrease in the USD and US dollars and about 5% in rand terms, for the quarter specifically, it has since in the recent weeks seen a bit of an improvement. The increased production contributed for us to still post stronger financial performance. And our net revenue increased about 6% to $21.9 million for the quarter, and a group EBITDA increased by about 16% to $3.3 million for the quarter. On the cost front, we've had good cost control during the period, and also aided by the increased production. Our group cash unit cost decreased by about 8% in rand and 5% in dollar terms. So overall, a good financial performance. And then finally, we just updated some of our exploration and growth projects. The Thaba JV project is still on schedule and on track to be commissioned in the second half of the financial year, as we communicated earlier. And we also just updated investors on the full spread updated scoping study that was released during August of this year, where we're seeing a improvement in the project ATV and also in the life of mine for the project. So overall, I think a good set of results, which we're very positive about.
Excellent. Good start to FY25. Considering both the financial and production improvements during Q1, how did you achieve these, and what levers can Sylvania still pull to increase its margin further? That is there further upside from the mill cell and Lesedi optimization strategy? And is FY25 guidance of 73 to 76k ounces of platinum group metals potentially conservative?
Yes, thanks. I think, we mentioned earlier, we saw this quarter production levels return to where they were pre the strike affected levels, and following a slower than anticipated ramp up after the strike period, obviously towards the end of 24. But that, if this behind us, the production is strong, and we expect a strong production performance for this year. So we talk about margins because of our relatively high fixed cost ratio. The main levers we have to pull to improve margins in Sylvania is, first of all, make sure we get our production ounces maximized. So have the plants at full capacity and maintain production levels. Then secondly is making sure we optimize PGM feed grades into the plant, because higher grades gives higher returns, and also recovery efficiencies. And then to maintain tight cost control. Obviously the basket price would improve margin significantly as it goes up, but we're not in control of that. If we look in quarter one in particular, we have saw a 7% improvement in the PGM feed grade, and that we achieved primarily through engagement with our host mines with some of the feed material that is we received from the host mines that was higher grade. Now, although we continuously engage with them to optimize the feed blends, we don't have direct control over the exact mining areas. but we do have, at least can tell you what blends would be better for our process. And then secondly, from a grade point of view, we continue to treat some external higher grade third-party material at our Eastern operations that we are buying in, that under the current PGM basket price is adding significant value to our business case. Otherwise, improvements and continue to optimize and increase our general operational efficiencies, plant efficiencies, to ensure we can return additional value. When we look at mill cell at Lesedi in particular, as you mentioned, I think firstly at mill cell we have progressed well, and actually now in the last week commissioned a new column cell at mill cell that is aimed at improving our final concentrate quality and hence therefore our payability achievement. And that's another way in terms of maximizing our margins. So we're looking forward as we commission and optimize that column cell to see what returns we can get by improving our overall profitability and payability on the metal. So that's going well at mill cell. And then at Lesedi in particular, where we initiated a performance enhancement initiative in August this year, we are also seeing promising results with optimization and initiatives of the plant. I think also as part of the host mine's drive to improve chrome production, they have recommissioned their Lesedi ROM plant, which is located at our Lesedi site, which has been on care and maintenance up to now, since they acquired it back in 2017 from the old IFM unbundling. And they're recommissioning that plant, which will secure a higher grade current rising feed source to our Lesedi operation. And that is very positive and would make a significant improvement in Lesedi's business case in going forward and also their profitability. So, finally touching on just the guidance, and do you think it might be too conservative? I do believe our guidance is currently accurate and well informed. While Q1 was strong, and we talked about these other improvements, Q2 and Q3 in South Africa are typically lower production quarters because of the host mines and mining industry in general in South Africa slowing down over December, January festive period. So we provided our forecast for a bit of slowdown, although we continue 24/7 throughout this period on our plants. We would treat lower grade dump material than the higher grade current risings and ROM feed sources. So we do believe that at this stage, our guidance is accurate, and at this stage we're seeing to change it.
Okay, we'll hold fingers. What's quite frustrating sometimes, as the lowest cost producer, PGM producer, with a 6% dividend yield and rising production, sometimes it's really frustrating to see your share price lagging the bigger producers with far less impressive results compared to you, Sylvania. Why do you think that is?
Yeah, Renee, talking about share price, unfortunately, we don't have full control over it, and especially compared to some of the bigger or primary PGM producers that you mentioned. There are often, different listings or investor sentiments, implications or impacts. So it's difficult to do a direct comparison. What we obviously try to do always is rather focus on the areas that we are able to control and, which should inform, the value and the share performance. So, and from that point of view, if we look at controlling the controllables, I'm very proud of our strategy in that regard. And we have a very consistent low cost strategy, very disciplined capital allocation policies, and also cash management. And the success of these strategies have been filtering through in our financial reporting, over the years. Obviously, I think something that must play a role as well is the PGM basket price performance and trends, and that has impacted companies across the sector, and many producers had to affect the job cuts, cut some of the production expansion projects. Whereas we have actually increased our workforce through the expansion of the Thaba, and we the continuing of the Thaba JV project, whilst maintaining our production level stable from existing operations, and also looking at maintaining our exploration investment in strategically to unlock value where we can there, and also, to make sure we fund projects like Thaba and explore further opportunities similar to that. all whilst looking at maintaining our shareholder returns and maintaining our ESG commitments. So, and I think that's the other important thing when you look at share price and value of Sylvania. We, through the strategy that we have, we've managed to deliver some very significant shareholder returns during the past years. A stable dividend since 2018. In this past financial year, 2024, we've paid out a dividend significantly higher than our, as dictated by our dividend policy. So, I think we're quite positive and proud about that. And then we've also had some significant share buyback initiatives over the past couple of years. So I think I'm confident that investors will see the value of our low cost strategy and being a profitable producer despite the market conditions. And we're sure that this will reflect and should reflect in our share price once a more favorable market environment returns. I think we're focusing on that. And I think maybe the last point that I know also investors look at is continuously looking at growth. And, that's partly the reason why we looking and sought after the projects like the Thaba JV to diversify our commodity portfolio, and which will give us bigger exposure to chrome and alternative revenues that we can maximize our profits.
Certainly, a good outlook. Could you provide us with an update on the progress of the new Thaba, the chrome and PGM joint venture that you're developing? And also, what's the outlook for PGMs and chromite, and how will it affect this project?
Yes, I think the Thaba JV specifically is a very exciting and a transformative project for us as a company. I think, it represents a significant and exciting diversification from our current business model and portfolio, where we just benefit from PGMs only at our mines. Although we produce a significant amount of chromite already at our current operations, we don't derive benefit from it from the agreement with our host mines. But at Thaba, we will see direct exposure to chrome revenues. And, it will be quite significant because at steady state, besides the 9% increase in attributable PGM ounces on our production profile, we would also have about 210,000 tons a year of attributable chrome. So certainly something that would be very positive for us, especially, if in more favorable market conditions. But talking about the current markets and how that impacts, because we have both the exposure to chrome and PGMs, it gives us, besides giving us commodity diversification, it gives you also some shielding in the cycles in the industry. And it's very rarely, if you look at historical chrome and PGM price trends, that both are down at the same time. And I think, as many PGM producers at the moment have benefited from chrome, the chrome miners that a couple of years ago had benefit from the PGMs. So we do look at both the markets, I think, and we do have a positive outlook still on both chrome and PGMs. I think the chrome market has not seen the same difficulty as PGMs in this last year or two. In fact, they have seen very attractive chrome prices. And if we look at the fundamentals of chrome, where the supply, South Africa with a major supplier globally, strong stainless steel demand still going forward, we have a robust outlook on chrome markets going forward. And then on PGMs, while we have seen a very low price environment during recent years, we also confident that the PGM price will improve. PGMs, all platinum, palladium, and rhodium, as in the immediate and short term are forecasted to be a deficit, and it's actually amazing that it hasn't reacted sooner already. But we do believe that there's strong demand and strong price prospects for the metal. So in both markets, we're confident. I think maybe just a last point on this chrome and PGM sector is the Thaba JV, as it is at current spot prices, where you have chrome higher and PGMs lower, you're probably looking at about 70 to 80% of your revenue being derived from chrome versus PGMs. And if you look at longer term consensus prices, you're probably at 60 to, closer to 50 to 60% chrome versus PGM prices. But it does give you that diversification and shield you in that position. And that's why it's an exciting project in what we believe still two good markets to be in.
It's like you said, I hope they are counter-cyclical. So if the one's down, the other one's up. So a good decision anyway. But just in terms of the market itself, we heard Sylvania cutting back about 200,000 ounces of PGMs at the Stillwater mine in Montana. Do you think there's going to be more production cuts coming?
Yeah, I think if you look at specifically the PGM cost curve and, where a lot of producers are under pressure in the current market, I do believe that there could well be some further cuts in the industry, and that should be supportive for overall market conditions if there is production coming out. I think also the balance between PGM and chrome prices, especially for the EGT producers, is significant. But we saw chrome slightly pulling back this last few weeks, and that might put additional pressure on some of the major PGM suppliers. So I do think there is still definitely production under pressure in the current market. So there could well be it. From our point of view, luckily, the size of our production, where we are positioned in the lower third or quartile to third of the cost curve, we fortunately don't have to consider these drastic steps. And we have announced a program with SEDI. We were looking at optimizing operations, but we do believe that is under control, and we don't anticipate any specific cuts on our side. And we with the projects we have in hand, like the Thaba JV, actually, as I said, we continue to invest in and making sure the important for us is to get that commissioned and operating as soon as possible, because then we can benefit from the current markets.
No, you're a very good spot on my cost curve anyway, on the quite close to the left-hand side. Just finally, Sylvania has 3 exploration projects on the northern limb, indicating potential good value add, and your recent Volspruit scoping study showed a significant increase in pre-tax NPV to $69 million. What is the significance of this to the future of the Volspruit project, which is closer to smelters compared to Aurora, the other project that you have, with its potentially shallow, higher grade reefs, Aurora that is? What signal will you need to press the trigger to bring them into production?
Yeah, thanks. I think we're excited by the prospect of our exploration projects, with all the ongoing programs showing the potential and prospectivity for these projects to add value to our portfolio. You have mentioned the Volspruit project. We have just in August presented the updated scoping study on it, and as you mentioned, there was a significant increase in the NPV on it. I think though, when you compare the returns to the existing dump operation or a project like a surface project, which is a low-risk surface project like a Thaba JV, then we believe that we're not on some par yet, and it's at the moment for us less attractive than those kind of projects. However, again, what are the levers to improve profitability on those projects? It is an attractive resource. We know what the pipeline for PGM projects look like going forward. So I think it is a good asset, and the way is to improve that is to make sure you improve metallurgical efficiencies so that you can get better concentrate grade and payabilities of your resource, and also to minimize your cost. And to that effect, we're currently busy with some optimization studies on Volspruit to see, okay, from the NPV, which is favorable, and the scoping study that we've done, how do we improve that? So how do we make that a more attractive and more robust project even at the current PGM prices? So that's where we are with Volspruit, and we have some promising results that both in terms of concentrate quality and also at improving metallurgical performance that we are working on, and will throughout this financial year will be communicated to the market. Volspruit, obviously, from a regulatory permitting point of view, and everything is closer to development, if you would decide to develop it, than the Aurora project, which where we have not done a scoping study yet. We have done MRE on a portion of the Aurora ore body, but which indicated some very attractive and high-grade reefs. So our focus currently on Aurora is to prove the continuity of the resource along the entire strike length, because that would help us to say what the overall size of resource is, and then that potential. But I think from a sequencing point of view, you're probably Volspruit slightly ahead of Aurora. Well, I think talking about signals, I think certainly a stronger PGM basket price would help. Those projects don't have any chrome content to it, so it's reliant purely on the PGMs. It has quite an attractive base metal content compared to our current resources, which is very low in base metals. So, copper and nickel exposure in those projects are also, byproducts are significant. So, yeah, overall PGM and also base metal prices would certainly improve. And then the other marker for us is to get the metallurgical performance, and then it will give you a better indication of these projects can be developed.
Thank you very much, Jaco. I think with lowest cost in the business, I'm pretty sure, with the lowest labor complement per ounce produced, and with the highest dividend in the sector, 6%. I mean, that's really quite high at this point in time in the PGM cycle. I really hope that some investors will start focusing attention on Sylvania. But thanks very much. Thanks very much, Jaco. Thanks.
Q&A. Thanks for the opportunity.
Great. Thank you.